it's done the Fed's job for it in the sense that it's tightened financial conditions really quite considerably. And there are analysts out there reckoning that the financial tightening is equivalent to around 25, 50 basis points hike as it is. But the issue for the Fed right now is that it's quite keen to separate out financial stability from the real economy insofar as it can. Of course, you never really can. But as Christine Lagarde of the European Central Bank said last week, there are different tasks for the Fed right now. So I suspect what the Fed will do is essentially continue to raise rates to signal its fight against inflation. So use a policy rate tool to basically try and go after inflation, but use its balance sheet to essentially try and stave off the financial instability risks. And we've seen that already. It's going to be very, very difficult. I'm very strongly in the camp of those who think the Fed made a terrible mistake to keep interest rates so low for so long. The reason we're having these shocks now is because it's had to overreact and jam on the brakes to essentially atone for the big mistake it made earlier. And I strongly agree with Peter that the fundamental problem, as I've written myself in numerous columns, is that most of the financial system has been geared to make a one-way bet on rates staying low forever, and they simply have not woken up yet to the risk. And the really big issue is that, yes, we started...
I would just argue they're aware of the risk. I would argue, Gillian, they're aware of the risk, but they're expecting the bailout. In other words, there's ignorance, and then there's just like, so these are not stupid people. These are people that benefited from the credit expansion in 2006, 7, 8, 9. Then there was a massive overcompensation, which was the zero rates to compensate for their previous mess, which everybody agrees the Fed is out of control, running zero and getting all these more. And now, First Republic has mortgages out in California for 2.5%, and their borrowing rates are 5.5% at the short end. That's not a shock, right? At some point, rates were going to go up. I'm arguing that the risk is egregiously mismanaged, whether it was going into 2006, 7, 8, 9, with the credit, with the ninja loans, or whether it's the leverage on short rates now, because they know they're going to get bailed out.
Well, and Gillian, is that the risk then of the FDIC making the guarantee more explicit and saying there's no limit, let's just guarantee all deposits? Is that the risk then, that you are encouraging further risk-taking behavior?
Well, the only thing that's worse than moral hazard, which the system is riddled with right now, is that you have unpredictable moral hazard. And that's worse than moral hazard. Because yes, at the moment, we now know, in retrospect, that the depositors at Silicon Valley Bank and Signature were rescued. Yes, Janet Yellen said yesterday that that rescue, that support, will extend to other regional banks if they fall into problems too. But we don't actually know how far the FDIC support goes, whether it's going to cover all the banks. And perhaps most critically of all, although we've seen the banks break first in relation to the interest rate cycle going up, or interest rates going up, and we're seeing some protection for them, what's going to happen if, say, commercial real estate starts breaking big time, as we've heard earlier, it may well start to do? What are we going to do about private equity, venture capital? What are we going to do about university foundations? There are many, many parts of the financial system right now which could also be hurt very badly by interest rates going up. And we just don't know whether the government's going to step in and provide that kind of moral hazard or support or bailout there as well.